Before we get started, please remember that the information in this presentation is for educational purposes only. I am not a licensed financial advisor, and this is not financial, legal, or tax advice. This video is designed to empower you with knowledge, but you should always consult with a qualified professional to discuss your own unique situation. He was 34 years old, a software engineer, a husband, a father of 2. Let's call him Mark. And like a lot of US, Mark had a life insurance policy through his job. At least that's what he thought he had. It was a $100,000 policy, provided for free by his company. It was called an AD&D policy. He signed the form during his onboarding, filed it away, and felt a sense of relief. He'd done the responsible thing. His wife, Jessica, and their kids were protected. He was covered. Then one Saturday morning, while driving his daughter to soccer practice, he felt a sharp pain in his chest. He managed to pull the car safely to the side of the road before collapsing over the steering wheel. A massive sudden heart attack. He was gone before the paramedics arrived. A few weeks later, through her unimaginable grief, Jessica filed the claim on that $100,000 policy. The policy that was supposed to be their safety net, the money that would keep the mortgage paid and the lights on while she figured out how to be a single mom. The claim was denied. Why? Because Mark didn't die in an accident. He died from a medical event. And that single devastating distinction, hidden in the fine print of a policy he never really understood, changed the entire course of his family's life. This isn't just a story. This exact scenario plays out in thousands of American homes every single year. A family is left grieving and on top of that, facing financial ruin, all because of a fundamental misunderstanding between two products that sound almost identical: life insurance and accidental death and dismemberment insurance. One is a fortress, built to protect your family from nearly any storm. The other is a ghost. It looks like protection, it feels like protection, but when you need it most, it often vanishes into thin air. The problem is, they are often sold together, bundled by employers, and presented as the same thing. And that confusion is a multi-million-dollar mistake that families, not insurance companies, end up paying for. But that's not going to happen to you. Because over the next few minutes, we are going to pull back the curtain and expose the critical difference. We're going to arm you with the knowledge to see through the marketing jargon and the confusing paperwork. By the end of this video, you will know with absolute certainty what each policy really covers, what they don't, and how to build a real wall of protection around your family's future. You won't just understand the definitions. You'll understand the strategy. You'll know how to make the smart choice, not the easy one. So let's start with the foundation. The heavyweight champion, the one you need to understand first. True traditional life insurance. Forget everything you think you know. Forget the pushy salespeople and the complicated charts. At its core, life insurance is the simplest and most powerful promise in the financial world. It's a contract. You agree to pay a relatively small amount of money on a regular basis, your premium, to an insurance company. In exchange, that company makes a legally binding promise. If you pass away while that contract is active, they will pay a large tax-free sum of money, the death benefit, to the people you've chosen. Your beneficiaries. That's it. That's the core of the deal. It doesn't matter how you die. Heart attack. Covered. Cancer. Covered. Car accident. Covered. A freak lightning strike while climbing Mount Everest? Covered. With only a couple of very rare exceptions like fraud on your application or a suicide within the first 2 years of the policy. If you die, the policy pays. Period. It is the ultimate just-in-case protection. It's designed to replace your income, to pay off the mortgage, to fund your kids' college education, and to give your family the one thing they'll need more than anything in the world when you're gone: time. Time to grieve without the crushing weight of immediate financial collapse. Now, this powerful promise comes in 2 main flavors. And this is where people start to get confused, but it's actually very simple if you think about it like housing. You can either rent your house or you can own your house. Life insurance is the same. You can rent it or you can own it. Renting your insurance is called term life insurance. This is by far the most common and, for about 95% of Americans, the most practical and affordable option. Just like renting an apartment, you sign a lease for a specific period of time, or a term. Could be 10 years, 20 years, or 30 years. You pay your monthly premium, which is fixed and guaranteed not to change for that entire term. If you pass away at any point during those 30 years, your family gets the full payout. If the 30 years ends and you're still alive and well, which is what we all hope for, the contract expires. The coverage ends. You stop paying and that's that. You were covered during the period you needed it most, while you were raising kids, paying off a mortgage, and building your wealth. It is pure, no-frills, cost-effective protection. It's simple, it's cheap, and it does its job perfectly. The other flavor is owning your insurance. This is called whole life insurance or sometimes permanent life insurance. Just like owning a home, it's designed to last your entire life. As long as you keep paying the premiums, the policy never expires. It will be there whether you pass away at age 45 or age 105. But also, like owning a home, it's significantly more expensive than renting. A whole life policy can cost 5 to 15 times more than a term policy for the same amount of coverage. Why? Because a portion of that higher premium goes into a savings or investment component called cash value. This cash value grows over time, tax deferred, and you can borrow against it or even cash it out later in life. It's a combination of a death benefit and a forced savings plan. Now, financial gurus will argue all day about which is better. Proponents of whole life love the lifelong coverage and the cash value accumulation. They see it as a stable, conservative asset. On the other hand, many experts argue that you're better off buying cheap term insurance, renting your protection, and investing the difference you save in something like a low-cost index fund. They argue you'll get a much better return in the long run. For most people, the buy term and invest the difference strategy makes the most financial sense. It provides the maximum protection for your family when they are most vulnerable, for the lowest possible cost. But the key takeaway here is this. Whether you choose term or whole life, the fundamental promise remains the same. It's a broad, all-encompassing protection. It covers death from illness, disease, and natural causes, which, let's be honest, is how the vast majority of people die. It is the solid bedrock of a financial plan. And you need to have that bedrock firmly in your mind. You need to understand that powerful, all-encompassing promise. Because now, we need to talk about its tricky, deceptive, and far more restrictive cousin. The policy that Mark had. The one that looks like a safety net, but is full of holes. Accidental death and dismemberment. So let's break down that name, accidental death and dismemberment. Sounds so official, so comprehensive. But the entire trap, the whole illusion, is built on that very first word, accidental. You and I, we have a common-sense definition of an accident. A car crash. A fall down the stairs. A tragic mistake. That's what we think of. But an insurance company, they don't use a dictionary. They use a contract. A contract written by teams of lawyers whose entire job is to minimize the company's risk. And in that contract, the word accidental is one of the most heavily fortified, narrowly defined, and weaponized words in the entire English language. To an AD&D policy, an accident isn't just an event with an unfortunate outcome. It has to be an event that is purely and exclusively the result of an external, violent, and unforeseen force. And most importantly, it cannot under any circumstances be contributed to or caused by any underlying physical or mental illness. Think about that for a second. Let that sink in. If you have a heart attack while driving and crash your car, most people would call that a tragic accident. Your family would call it an accident. The police report would call it an accident. But the AD&D policy calls it a death by heart attack, a death by natural causes, and it pays exactly 0. If you have a seizure and fall down a flight of stairs, death by seizure, 0. If you have a stroke, lose your balance on a ladder and fall, death by stroke, 0. If a diabetic episode causes you to become disoriented and walk into traffic, death by complications from diabetes, 0. This is precisely what happened to Mark. He was a 48-year-old man, a little overweight, with blood pressure that was a bit on the high side like millions of other Americans. One rainy Tuesday morning on his way to work, his car hydroplaned, spun out, and hit a guardrail. He died at the scene. It was a single-car crash. A clear, undeniable accident. Or so his wife Sarah thought. When she filed the claim on his $500,000 AD&D policy, the one he got for free through his job, the one he told her would take care of her and the kids if anything ever happened to him, she was confident. Devastated, but confident that at least the financial side would be okay. The denial letter came 6 weeks later. It was cold, clinical, and just 2 pages long. Buried in the second paragraph was the justification. The autopsy had found evidence of cardiac arrhythmia. The insurance company's medical underwriters argued that it was this irregular heartbeat that caused Mark to lose control of the car in the first place. The proximate cause of death, they stated, was not the crash. It was a medical event. Therefore, the death was not accidental, under the strict definitions of the policy. Claim denied. $500,000 vanished. Poof. Gone. All because of a microscopic detail in his medical history that his own family wasn't even aware of. Sarah wasn't just grieving her husband. She was now fighting a faceless corporation that had used a technicality to rip away her family's future. This isn't a rare occurrence. This is the business model. The list of exclusions on these policies is staggering. Death during a surgical procedure? Often not covered because it's a complication of a medical treatment. A fatal allergic reaction to a bee sting? That's your body's internal reaction. An anaphylactic shock, often classified as a sickness, not an accident. Overdose on a prescribed medication? Excluded. Death while intoxicated, even if you're a passenger? Excluded. And it gets even darker. Nearly all AD&D policies have a suicide exclusion, which makes sense on the surface. But they often extend that to any intentionally self-inflicted injury. So if you die from something that could be perceived as a reckless hobby, like rock climbing, scuba diving, or even riding a motorcycle in some cases, they can argue you intentionally put yourself in harm's way and deny the claim. It's a minefield. And we've only talked about the death part. What about the dismemberment? This is the other side of the coin, and it's just as misleading. The policy creates the impression that if you survive a terrible accident but are permanently injured, you'll get a payout to help you adjust to your new life. The reality is a rigid, unforgiving checklist called a schedule of losses. This schedule dictates exactly what they'll pay for, and it's brutal. Losing a hand might pay out 50% of the policy's value. Losing a foot, another 50%. Losing the sight in one eye? Maybe 25%. Both eyes? 100%. But here's the fine print they count on you not reading. It's not about losing the use of a limb. In most policies, you have to experience actual physical severance. So if your hand is crushed in a machine at work and is now permanently paralyzed and useless, but it's still attached to your body, you get 0. If you lose your hearing in an explosion, 0 because your ears weren't physically severed. If you suffer a spinal cord injury in a car wreck and are paralyzed from the waist down, you haven't lost your feet. You've lost the use of them. The policy pays 0. You have to lose the limb. It has to be cut off. It's a barbaric and outdated definition of loss, but it's the one that saves them millions. So why do these policies even exist? And why do so many people like Mark have them? Because they are incredibly cheap. And they are cheap for a very simple reason: they almost never pay out. The Centers for Disease Control, the CDC, tells us that for an adult in the prime of their working years, say age 40, the odds of dying from any cause are relatively low. But the odds of dying from a pure accident that fits the narrow legalistic definition in an AD&D policy, the odds are minuscule. Insurance is a game of statistics, and the insurance companies have run the numbers. They know that the vast majority of deaths are caused by, or contributed to by, illness and disease. Cancer, heart disease, stroke, diabetes, pneumonia. These things account for the overwhelming majority of deaths in America, and AD&D covers none of them. So when your employer offers you a free $100,000 AD&D policy as part of your benefits package, it's not an act of pure generosity. It's a calculated move. It costs them pennies per employee, because the insurance carrier knows the risk is practically non-existent. It allows the employer to put a big, impressive number on your benefits summary, making you feel protected, making you feel valued. It's a psychological trick. You see $100,000 life insurance benefit, and you don't look any closer. You don't realize it's not a life insurance benefit at all. It's an accident-only lottery ticket, and the odds are not in your favor. It's the illusion of security. It's a safety net woven with thread so fine it breaks the moment you actually fall into it. Mark thought he was protecting his family. He checked the box, he got the benefit, and he assumed the promise was real. But the promise was a mirage. The protection he thought he was providing was built on a foundation of exclusions, technicalities, and fine print. So if AD&D is this restrictive, this full of holes and trapdoors, what's the alternative? How do you get real protection? The kind that pays out when your family actually needs it, without lawyers and loopholes? That brings us back to the other side of the coin. The policy that looks at death and asks only one question: are you dead? Yes or no? The policy that would have saved Mark's family. True, simple, powerful term life insurance. And understanding how that works is the single most important financial decision you will ever make. So let's talk about that promise. The one that Mark thought he had. The one his family desperately needed. Term life insurance isn't like that complicated, loophole-ridden AD&D policy. It doesn't have a list of approved ways to die. It's a simple, profound contract. It says if you die during a specific period of time, the term, we pay your family a tax-free lump sum of cash. Period. Full stop. It doesn't care how. Doesn't care why. It doesn't ask for a police report or a medical examiner's detailed analysis of whether your heart attack was technically an accident or an illness. It only asks one question, the same question we ended on before. Are you dead? Yes or no? If the answer is yes, the check is cut. Let's rewind the clock. Let's go back to that horrible morning when Mark's wife got the call. But in this version of reality, let's imagine that 6 months earlier Mark sat down for 20 minutes and bought a simple $1 million 20-year term life insurance policy. He did it online. It cost him about $35 a month, less than his family's pizza night. He probably complained about the cost, another small bill to pay. He probably thought it was a waste of money. Healthy guys in their 30s don't just die, right? But in this reality, after the funeral, after the casseroles stop coming, after the world moves on and leaves his family in the quiet, deafening silence of their grief, something different happens. A letter arrives. Not a letter of denial filled with legal jargon and clauses. It's a simple envelope, and inside is a check. A check for $1 million. What does that check do? It's not magic. It doesn't bring Mark back. It doesn't erase the pain. But it buys them time. Buys them options. It pays off the $300,000 mortgage on their house instantly. The single biggest financial burden is gone. Forever. They will never have to worry about losing their home. The home their kids grew up in. The home filled with memories of their father. It sets aside $200,000 for each of his 2 kids. That money goes into an account and it grows waiting for them. When they turn 18, their college education is paid for. The dream Mark had for them, the dream he worked for every single day, is secure. It will happen even though he's not there to see it. And the rest? The remaining $300,000? That's the breathing room. That gives his wife the ability to not rush back to a job she isn't ready for. It lets her grieve. It lets her be a full-time mom for a year, or 2 or 3, to help her children navigate a world that has been shattered. It pays for groceries. It pays for the light bill. It pays for therapy. It pays for a life. It's not a replacement for a husband and a father. It's a testament to his love. It's the final act of a man who loved his family so much that he protected them even from beyond the grave. That is the power of term life insurance. Now, the name itself sounds a little boring, right? Term. It just means for a period of time. Think of it like renting an apartment. You need a place to live for a specific term, 1 year, 2 years. You pay a small amount of rent each month, and in exchange, you get the full use and protection of the entire apartment. You don't own it, you're just protecting your family with it for as long as you need it. Term life insurance is the same. You're renting the death benefit. You choose a term, typically 10, 20, or 30 years. This is designed to cover you during your most vulnerable financial years. The years when you have a mortgage. The years when your kids are young and completely dependent on your income. The years when your spouse relies on you. You pay a relatively small monthly premium, and if you die during that term, your family gets the entire payout. 1 million, 2 million, whatever you chose. If the term ends and you're still alive and well, the policy expires. You stop paying. That's it. You don't get any money back. And people hear that and think, what? So I paid for nothing. No, you paid for peace of mind. You paid for protection. It's like car insurance. You pay for it every month and you hope to God you never have to use it. But you're not mad if you don't get in a car crash at the end of the year, are you? You're relieved. Life insurance is the same. It's a seatbelt for your family's financial future. You paid for the guarantee that if the worst happened, your family would be okay. You paid for a good night's sleep. That's not nothing. And here's the secret: the insurance industry doesn't really want you to shout from the rooftops. For most people, term life is incredibly, almost shockingly, cheap. People think life insurance costs a fortune. A recent study showed that most Americans overestimate the cost of term life insurance by more than 3 times. Millennials overestimated it by 5 times. We think it's a luxury product for the rich. Let's go back to Mark, a healthy 35-year-old man. A $1 million policy for a 20-year term. I said it was about $35 a month. That's a real number. For many people, it's even less. We're talking about the price of 2 or 3 fancy lattes. The price of a Netflix and a Max subscription combined. for the ability to completely secure your family's future, to pay off the house, fund college, and replace your income. It is, without a doubt, the single greatest bargain in the entire financial world. So if it's so simple, so powerful, and so cheap, why doesn't everyone have it? And why did Mark's employer push him into that AD&D garbage instead? Because simple and cheap doesn't make a lot of money for insurance companies and their agents. The big money, the huge commissions, are in the other types of life insurance. The complicated ones. The ones that bundle insurance with so-called investment components. You've probably heard the names: whole life, universal life, variable life. They sound permanent. They sound robust. They are sold with promises of building cash value, of being an asset you can borrow against. And for a tiny, tiny fraction of the super wealthy population, they can sometimes make sense as a complex estate planning tool. But for 99% of us, for regular people like you and me, like Mark, they are a financial trap. They combine a very expensive version of life insurance with a terrible, high-fee, low-return investment. It's like buying a car where the radio is permanently welded to the transmission. If the radio breaks, you have to replace the whole engine. It makes no sense. Agents push these policies because the commissions are massive. We're not talking about a small percentage. The commission on a whole life policy in the first year can be 50, 80, even over 100% of the entire first year's premium. So if your premium is $10,000 for the year, the agent who sold it to you could be walking away with a check for $10,000. Your entire first year's payment can go straight into their pocket. Now, compare that to a simple term policy. The commissions are tiny, a few $100 maybe. So if you're an agent and you have a choice between selling a simple, cheap product that is perfect for your client or a complex, expensive product that pays you 50 times more, which one do you think gets pushed? This is the dirty secret. The industry is built to steer you towards complexity and cost, not simplicity and value. They prey on our fear of death and our confusion about finance to sell us overpriced, underperforming products. They make it seem so complicated that you feel like you need an expert to guide you. And that expert just happens to make a fortune by guiding you to the most expensive option. So how do you fight back? You arm yourself with knowledge. You understand the fundamental difference. Term insurance is pure, simple protection. That's it. You keep your investments separate from your insurance. You buy cheap term life to cover your protection needs, and you invest the money you save in a low-cost index fund or your 401k. Do that, and you will be financially light years ahead of someone stuck in an expensive whole life policy. The first step is figuring out how much you actually need. People pull numbers out of thin air. 100,000? $250,000? For most people, that's not even close to enough. It sounds like a lot of money, but after a funeral, a mortgage, and a few years of lost income, it evaporates. A good rule of thumb, a starting point, is to have a policy that's at least 10 to 12 times your annual income. So if you make $80,000 a year, you should be looking at a policy around $800,000 to $1 million. That sounds huge, but that's what it takes to truly replace your economic value to your family over the long term. Think about a young woman named Sarah, a 32-year-old architect married with a 4-year-old daughter. She and her husband had just bought their first home. Sarah was the planner. She did the research. She didn't talk to an agent. She went online, compared quotes, and understood that term life was exactly what her family needed. She calculated their mortgage, the cost of daycare, future college tuition, and her income. She bought a $1.5 million 30-year term policy. She did everything right. She was protecting her family. She was ensuring that no matter what, her daughter would have the future she dreamed of for her. And then 2 years later, she went in for a routine checkup. The doctor found a lump. Stage 3 breast cancer. Aggressive. The fight of her life had just begun. But through the fear and the uncertainty, Sarah and her husband had one small piece of comfort. They knew that financially they were secure. They had that $1.5 million promise locked in. But what they didn't know was that on page 14 of her policy application, in a section she barely glanced at, was a single clause. A clause that the insurance company was now going to use to argue that their promise, that sacred contract, was completely void. And it all came down to a simple question she had answered 2 years earlier. The question was number 17 on page 4 of the application, nestled between a query about scuba diving and one about piloting private aircraft. It was a standard question, one on every life insurance application in the country. It read, "In the last 12 months, have you used tobacco or nicotine products in any form?" John, with Sarah sitting beside him at their kitchen table, had checked the box labeled no. And in that moment he believed it was the truth. He'd been a social smoker for years, a cigarette here and there at a party, a cigar on the golf course. But 2 months before they filled out that application, he had decided to get serious about his health for his growing family. He'd thrown out his last pack, sworn off the golf course cigars, and hadn't touched tobacco since. So when he saw the question, in the last 12 months, he hesitated. Sarah saw him pause. "Well, you quit, honey," she'd said. "That's what matters. You're not a smoker anymore." He nodded, smiled, and checked no. Felt right. Felt honest. But insurance companies don't operate on what feels honest. They operate on what is factually accurate. And the fact was John had used tobacco in the last 12 months. The letter from the insurance company's legal department was cold and clinical. It stated that during their routine claims investigation, they had uncovered a material misrepresentation on John's initial application. They had subpoenaed his medical records, which was standard practice for a large claim. His doctor's notes from a physical 9 months before he applied for the policy clearly listed him as a moderate smoker. That was strike one. Then they did something Sarah never imagined they could. They pulled his credit card statements. And there it was, a charge from a specialty cigar shop just 4 months before he died. He'd bought a single, expensive cigar to celebrate his brother's engagement. A one-time thing. A celebration. But to the insurance company it was proof. It was strike two. The letter then referenced the clause Sarah had never noticed. It's a clause that exists in virtually every life insurance policy, and it is arguably the most important one for the first 2 years. It's called the contestability period. Think of it like a probationary period for your life insurance policy. For the first 2 years after the policy is issued, and this is a crucial time frame, typically 1 or 2 years depending on the state, the insurance company has the right to investigate or contest any claim for any reason. They can put every single answer you gave on your application under a microscope. And if they find a material misrepresentation, a fancy legal term for a lie or an omission that would have caused them to either charge you a higher premium or deny you coverage altogether, they can void the entire policy. It doesn't matter how the person died. John's death in a car accident had absolutely nothing to do with smoking. But that's the brutal reality of the contestability period. The misrepresentation doesn't have to be related to the cause of death. You could say on your application that you don't have a history of heart disease, and then die in a skydiving accident. If they find out you lied about the heart disease within those first 2 years, they can deny the claim and just refund the premiums paid. To Sarah, this felt like a cosmic injustice. Trick. John didn't lie to defraud the company. He lied, if you could even call it that, because he genuinely saw himself as a non-smoker. The celebratory cigar was a footnote, an irrelevance. But to the actuaries at the insurance company, it wasn't irrelevant at all. A smoker's policy for a man John's age would have cost 3, maybe 4 times as much. They would have charged a higher premium. Therefore, his answer was a material misrepresentation. The contract, in their eyes, was built on a lie. And because John had tragically died just 22 months after the policy was issued, inside that 2-year contestability window, they had every legal right to tear that contract up. All they had to do was send Sarah a check for the roughly $4,000 in premiums John had paid. In their minds, it was case closed. They were square. Sarah felt the floor drop out from under her. Every plan she and John had made, every safety net they thought they had built, was based on that $500,000 promise. Now it was gone, replaced by a check that wouldn't even cover 2 months of the mortgage. She was standing in the middle of a legal minefield she never knew existed. This is the power and the peril of a life insurance policy in its infancy. That 2-year period is a tightrope walk. It's why honesty on an application isn't just a moral suggestion. It's a contractual necessity. Even small, seemingly innocent white lies can have catastrophic consequences. Did you forget to mention a prescription you took 3 years ago? Did you downplay your family's medical history? Did you estimate your income a little too generously? During the contestability period, any of these could be grounds for denial. Now, this might sound terrifying. It might make you think that life insurance is a scam, a rigged game where the house always wins. But there's a flip side to this coin. A protection for you, the policyholder, that is just as powerful. It's called the incontestability clause. Once that 2-year probationary period is over, the script flips entirely. The policy becomes incontestable. The insurance company essentially loses its right to challenge the validity of the policy or deny a claim based on a misrepresentation in the application. If John had checked that no box and then lived for 2 years and 1 day before his accident, the insurance company would have had almost no choice but to pay the full death benefit. They could have discovered he smoked a pack a day, that he lied about his entire medical history. It wouldn't matter. The window for contesting the policy would have closed forever. The contract would have become ironclad. This clause is a cornerstone of consumer protection in the life insurance industry. It provides peace of mind. It ensures that after a reasonable period, your family won't have to fight a legal battle over a mistake you might have made on an application years earlier. It forces the insurance company to do their due diligence, their underwriting up front, not after you've died. The only major exception is outright fraud, like if someone else took the medical exam for you. But for regular mistakes or misstatements after 2 years, you are safe. Sarah and John were not safe. They were caught in the storm of the contestability period, just 2 months shy of the safe harbor of incontestability. The timing was a dagger to the heart. She sat there staring at the denial letter, the words blurring through her tears. Felt so final, so absolute. The company's lawyers had made their case, citing the application, the medical records, the credit card statement. They had constructed a fortress of legal arguments. Seemed impenetrable. For days she did nothing. The grief was a heavy blanket, and this news was a weight pressing it down, suffocating her. The promise was broken. The future was gone. She was about to pick up the phone and call her parents, to tell them she was losing the house, that she had to move back home. But as she reached for the phone, her eyes fell on the pile of paperwork from the hospital. The thick manila envelope containing the police report, the paramedics' notes, the coroner's official report. She had barely been able to look at it. But a thought, small and defiant, sparked in her mind. The insurance company's investigators had been thorough. But were they perfect? They had built their case on John's past. But what if they had missed something about the moment he died? What if the answer wasn't in the application he filled out 2 years ago, but in the last 5 seconds of his life? And that's where Sarah's last hope rested. In those last 5 seconds, she was no longer just a grieving widow, she was a defendant. The insurance company had put her husband's entire life on trial, and now they were putting his death on trial too. The denial letters were cold, clinical. The life insurance denial was thick with legal jargon about material misrepresentation during the contestability period. The AD&D denial was shorter but somehow crueler. It hinged on a single brutal clause: an exclusion for any loss caused by or resulting from mental or emotional disorders. They were essentially saying his depression made the crash an act of self-harm, not an accident. Sarah felt the walls closing in. She had 2 denials, 2 separate battles to fight. She started calling lawyers. The first one she spoke to was sympathetic but blunt. Look, the contestability period is ironclad. If he didn't disclose his medical history, that's a tough hill to climb. Very tough. The second lawyer was even more dismissive. An AD&D claim with a history of depression? The company will argue he had intent. It's your word against a multi-billion-dollar corporation's legal team. I can't take that on. One after another, the doors closed. It felt like a confirmation of her worst fears. That the system was built to protect the powerful. That the fine print was designed to be a trap. She was about to give up when a friend gave her one last name: David Coleman. He wasn't a big-shot lawyer from a downtown skyscraper. He worked out of a small, unassuming office, and his specialty was fighting insurance companies. He was the guy you called when the giants said no. Sarah sat across from him, the denial letter spread out on his desk like a losing hand of cards. David, a man in his late 50s with eyes that had seen every trick in the book, read them slowly. He didn't speak for a long time. He just read and reread, tapping a pen on a legal pad. Finally, he looked up at Sarah. "They're coming at you from 2 different directions," he said, his voice calm and steady. "It's a classic pincer move. For the life insurance," he tapped the first letter, "they're attacking the past. They're arguing the contract itself is invalid, because John wasn't truthful on the application 2 years ago. For the AD&D," he tapped the second letter, "they're attacking the present. They're not even arguing about the contract. They're arguing about the event itself. They're saying the crash doesn't qualify as an accident under their definition." This was the first time anyone had explained it so clearly. It wasn't one problem. It was 2 distinct legal challenges. The first fight over the life insurance is about precedent and paperwork, David continued. "We have to argue that his omission wasn't material. We have to prove that even if they had known about his struggles, they still would have issued a policy, perhaps at a different rate. It's an uphill battle, but it's been won before. He leaned forward. But the second fight, the AD&D claim, that's where things get interesting. That's not about paperwork. That's about physics. It's about the last 5 seconds of your husband's life. He explained that accidental death and dismemberment policies have an incredibly specific definition of accident. For a claim to be paid, the event must be caused solely by accidental means. This means the cause of the injury or death must be sudden, unforeseen, and external. The insurance company's argument was simple. John's depression was an internal factor. They were claiming it was the driving force behind the crash. Therefore, the cause wasn't purely external. It was a clever, almost surgical argument that twisted John's personal struggle into a legal weapon against his own family. So what do we do? Sarah asked, her voice barely a whisper. We do what they didn't, David said, a spark of defiance in his eye. They built their case by looking at John's medical files from 2 years ago. We're going to build our case by looking at the twisted metal in the asphalt. We're going to ignore their story about who John was, and we are going to find the truth of what happened. For the next 2 weeks, David's office became a command center. He subpoenaed everything. Not just the police report Sarah had, but the full, unredacted case file. He requested the raw data from the car's event data recorder, its black box. He hired an independent forensic mechanic to re-examine the photos of the wreckage. He was looking for a ghost, a detail that everyone else had missed. The insurance company's case rested on a chain of assumptions. Assumption 1, John had depression. Assumption 2, people with depression can be reckless. Assumption 3, therefore John was driving recklessly. Conclusion, the crash was a result of his internal state, not an external accident. David's job was to break that chain. He explained the concept of proximate cause to Sarah. Imagine a line of dominoes, he said. The insurance company is saying the first domino, the one that started everything, was John's mental state. We need to find another first domino. We need to prove that something else set that chain of events in motion, and that John's actions were a reaction to that event, not the cause of it. Days turned into nights. David and his paralegal were buried in paperwork. The toxicology report was clean. The witness statements were inconclusive. They just saw a car lose control. The event data recorder showed the car was traveling at the speed limit. Then a sudden, sharp turn and rapid deceleration. Told them what happened but not why. It was a dead end. The insurance company's narrative, the story of a troubled man driving recklessly, seemed to fit all the known facts. David was starting to feel the same frustration Sarah had felt. The company had built a fortress of a case. But he knew from years of experience that these fortresses always had a flaw. You just had to be willing to check every single stone. It was almost 2 a.m. on a Thursday when he found it. He was cross-referencing the vehicle identification number from the police report with the National Automotive Database. A long shot he ran on every vehicle case. He was looking for anything, unreported repairs, a salvage title. For hours, nothing. And then a single flag popped up on his screen. It wasn't a repair history. It wasn't a salvage title. It was a recall notice, issued by the car manufacturer just 3 months before John's accident. A voluntary safety recall. David's heart started to pound. He clicked the link, and the words on the screen seemed to glow in the dark office. The recall was for a critical failure in the electronic power steering module. The description of the potential defect was chilling. It read, "A failure of the power steering module can result in a sudden and unexpected loss of steering control, causing the vehicle to pull sharply to one side without driver input." David printed the document. He held the piece of paper in his hand, the ink still warm. This piece of paper didn't prove John wasn't depressed. It didn't erase the misrepresentation on his life insurance application. But it did something far more powerful. It introduced a completely new suspect into the last 5 seconds of John's life. It presented a new first domino. The question was no longer just about what was happening inside John's head. The question was now, what if John wasn't the one steering the car at all? This single, explosive question changed everything. It was a wrecking ball to the neat, tragic narrative the insurance companies were building. If John wasn't driving, then he wasn't in control. If he wasn't in control, he couldn't have intentionally caused his own death. The suicide exclusion, that 2-year ticking clock that was about to save the life insurance company millions, would become irrelevant. And the AD&D policy, which hinged entirely on the death being a pure bona fide accident, would suddenly snap into sharp focus. The theory didn't come from thin air. It came from a detail so small, so seemingly insignificant, that it had been dismissed by the initial police report and overlooked by everyone else. It came from the mud. The crash had happened after a week of heavy spring rain, and the shoulder of the road was a soft, messy slurry of dirt and grass. The first responders, the police, the tow truck driver, they had all left their marks. But deep inside the driver's side wheel well, protected from the chaos, a crime scene technician had found a partial shoe print. It was a clean, deep impression. The problem was, the tread pattern didn't match the expensive Italian loafers John was wearing when they found him. It didn't match the standard issue boots of the police or the paramedics. It didn't match anything in the database. It was an anomaly, a ghost at the scene of the crime. For the insurance companies, this was a nightmare. An anomaly means ambiguity. An ambiguity in a death claim is like blood in the water for lawyers. The investigator for the life insurance company, a man named Miller, felt a cold knot tighten in his stomach. His job was to find grounds for denial. His entire case was built on the rock-solid foundation of John's depression, his financial ruin, and the physics of a single-car accident. He had a narrative. It was clean, sad, and most importantly, it was cheap for his employer. This shoe print shattered that narrative. Now Miller had to reinvestigate the entire case, but this time he wasn't looking for proof of suicide. He was looking for proof of anything else. This is a critical distinction in the world of insurance. The burden of proof. Initially, the burden was on Sarah, John's widow, to prove his death was an accident to claim the AD&D policy. For the life insurance policy, because the death occurred within the 2-year contestability period, the burden was on the insurance company to prove it was a suicide. Miller was confident he could do that. But now, with the ghost shoe print, the burden was shifting. A plausible alternative had been introduced. A jury might see that shoe print and decide there was reasonable doubt that John had taken his own life. And in insurance claims, reasonable doubt can cost millions. So Miller's investigation took a hard left turn. He was no longer a claims adjuster. He was a homicide detective without a badge. He started with the car itself, now sitting in an impound lot. He hired a private forensic team to tear it apart, piece by piece. They weren't just looking for mechanical failure anymore. They were looking for signs of a struggle. They swabbed the steering wheel, the gear shift, the passenger seat, looking for foreign DNA. They analyzed the scuff marks on the door panels. Was that mark on the passenger side from John's briefcase? Or was it from the heel of a boot, kicking out in a panic? Every detail was re-examined through this new lens. The lack of a suicide note, once seen as a sign of a sudden, impulsive act, now looked suspicious. People who stage murders to look like suicides often forget the note. The single set of skid marks, once seen as proof of John's last-second hesitation, could now be interpreted as the mark of a driver unfamiliar with the car, overcorrecting on a turn. This brings us to a crucial concept in AD&D insurance: the chain of causation. AD&D policies are notoriously strict. They cover you if you die as a direct result of an accident. If you have a heart attack while driving and crash, the heart attack is the cause of death, not the crash. The AD&D policy won't pay. But what if there was a struggle in the car? What if someone held a gun to John's head? And in the ensuing fight for control, the car veered off the road. The cause of death on the certificate would still be blunt force trauma from the crash. But the proximate cause, the legal term for the event that set everything in motion, wasn't an accident. It was an assault. It was a felony. And here's where AD&D policies have another nasty little surprise hidden in the fine print: the felony exclusion. Most policies state that if the death occurs during the commission of a felony, either by the insured or to the insured, the policy is void. If John was being carjacked, kidnapped, or assaulted, that could, believe it or not, give the AD&D provider an out. They could argue the root cause wasn't an accident in the pure sense they define it, but a criminal act, which is specifically excluded. It's a brutal, cynical piece of legal maneuvering, but it's used all the time. One insurance company might be on the hook for millions if it's a murder, while the other could walk away scot-free. You can see why both companies were now sweating, running their own parallel investigations, each hoping the truth would favor their balance sheet. Miller's team started digging into John's life, not just his finances, but his relationships. They re-interviewed his business partner, Mark. The first time, the questions were gentle, focused on John's state of mind. This time they were sharp, accusatory. Where were you on the night of the crash? Who can verify your alibi? Do you own a pair of work boots with a hexagonal tread pattern? They pulled phone records not just for John but for his wife Sarah, for Mark, for his entire inner circle. They were looking for cracks, for inconsistencies, for a secret that could have gotten John killed. And that's when they found it. Buried in 3 months of John's credit card statements was a recurring charge. A $100 charge every Tuesday morning, at a rundown motel 30 miles from his home, called the Sleepy Hollow Inn. It was a place you went when you didn't want to be found. John was a family man, a devoted husband, or so everyone thought. But for 12 straight weeks leading up to his death, he was checking into a motel alone and paying for a room for a few hours. The discovery of the motel stays opened up a Pandora's box of possibilities. Was he having an affair? Was he meeting someone for a secret business deal? Was he being blackmailed? Each theory pointed away from suicide and toward a confrontation. It suggested John had a secret life, and that secret life may have finally caught up with him on a dark, wet country road. Miller drove out to the Sleepy Hollow Inn himself. It was even more depressing in person than it looked online. He showed the clerk at the front desk a picture of John. The man, old and weathered, barely looked up from his crossword puzzle. He grunted, said he saw 100 faces a week and didn't remember any of them. But as Miller was about to leave, he tried a different tactic. He pulled out a different photo, one the police didn't have. It was a candid shot from John's office Christmas party. In the background, partially obscured, was John's business partner, Mark, laughing with a client. Miller pointed to Mark. "How about this guy? Ever see him here?" The old clerk finally put his pencil down. He squinted at the photo, his eyes lingering for a moment longer than they should have. He looked back at Miller, then back at the photo. And in that moment, the entire case, the entire multi-million-dollar question of accident versus suicide, hinged on the shaky memory of a motel clerk. The clerk slowly pushed the photo back across the counter. "Yeah," he said, his voice a low gravelly whisper. "I've seen him. He was here last week, asking about the same room your friend used to rent." My heart didn't just drop, it vaporized. A cold electric dread snaked up my spine. Someone else was here, pulling at the same loose thread I was. But why? My voice was tight, barely a whisper. Asking about the room? What did he want to know? The clerk shrugged, a slow, deliberate movement of his bony shoulders. He was enjoying this, the small sliver of power he held. "Same as you. Wanted to see it. Asked if the guy who, if he left anything behind. And did you let him in?" He finally looked me in the eye, his gaze flat and weary. "Police sealed it for 2 days. After that, it's just a room. Housekeeping cleaned it out. We rented it the next night. The guy, the one you're asking about, he just wanted to look. Stood in the doorway for a minute, then left. This wasn't some grieving friend. This was something else." "What did he look like? Did you get a name?" The clerk let out a short, humorless laugh. "A name? People who stay here, they use cash. They don't offer names unless they have to. He was just a guy. Medium height, dark jacket. Wore a baseball cap pulled down low. Paid me $20 to forget he was ever here." He tapped the counter. "Looks like my memory's getting better." I slid a 50 across the worn laminate. "How about a little better?" He pocketed the bill without breaking eye contact. He drove a sedan. Dark blue, maybe black. Old. An American car. That's all I got. Now I've got work to do. He turned his back, a clear dismissal. I walked out of that stale, fluorescent-lit office and into the blinding afternoon sun, my mind reeling. A dark car. A man in a baseball cap. It wasn't much, but it was more than nothing. It was a crack in the official story. A story that Sarah, Mark's widow, was depending on me to break. Because right now that official story, the one neatly typed up in a police report labeled suicide, was about to cost her everything. This is where the sanitized world of insurance brochures and friendly agents crumbles away. And you see the cold, hard machinery underneath. It all comes down to 2 little words. Contestability period. When you buy a life insurance policy, the company doesn't just take your money and trust you. For the first 2 years, that policy is essentially on probation. This is the contestability period. During this time, if you die, the insurance company has the right to launch a full-scale investigation, not just into your death, but into the life you lived and the answers you gave on your original application. They will pull your medical records, your driving history, your financial statements. They're looking for one thing: material misrepresentation. Did you say you were a non-smoker but occasionally had a cigar with your buddies? That's misrepresentation. Did you forget to mention you went skydiving once 5 years ago? They might try to argue that's a misrepresentation of your risk. Did you understate your weight, overstate your income, or fail to disclose a doctor's visit for anxiety? They will find it. And if they can prove you lied about anything material, anything that would have caused them to charge you a higher premium or deny you coverage altogether, they can tear up the contract. They won't pay the death benefit. They'll just send your grieving family a check for the premiums you paid in, a few $1,000s instead of the million you planned for them. Mark had died 1 year and 4 months after his policy started. He was deep inside the contestability period. So right now, I knew an investigator from the life insurance company was dissecting my friend's entire existence, looking for any excuse not to pay Sarah. The suicide ruling was their silver bullet. Almost every life insurance policy has a suicide clause. It's separate from the contestability period, but they often run for the same length of time, typically 2 years. If the insured dies by suicide within that window, the policy is void. No payout, just a refund of premiums. So, the insurance company had the police report on their side. Case closed. They could deny the claim and legally, they'd be on solid ground. Unless it wasn't a suicide. The image of the man in the baseball cap flashed in my mind. His presence meant Mark's death might not have been a simple, tragic, open-and-shut case. And that's where the second policy came into play. The accidental death and dismemberment. AD&D. Life insurance and AD&D are often sold together, but they are fundamentally different animals. Life insurance is a broadsword. It covers death from almost any cause. Cancer, heart attack, car crash, falling piano, you name it. As long as you're past the contestability and suicide periods, and you didn't lie on your application, it pays. AD&D is a scalpel. It is surgically precise and incredibly limited. It only pays for a death caused by an accident. And the definition of accident is where everything gets complicated. The policy is a minefield of exclusions. Think of it as a list of ways you can die that the company will not pay for. Die from a heart attack? Not an accident. That's a natural cause. No payout. Die from cancer, pneumonia, or any other illness. Not an accident. No payout. Die while serving in the military in a time of war? That's a specific exclusion. No payout. Die while committing a felony? Exclusion. No payout. Die from a drug overdose? Most policies will call that self-inflicted and deny the claim. And of course the big one, die by suicide? That is the textbook definition of a non-accidental, intentional act. It is always excluded. So on the surface, both of Mark's policies were heading for denial. The life insurance would cite the suicide clause. The AD&D would cite the suicide exclusion. Sarah would get nothing but a refund check and a mountain of debt. But the man in the motel changed the entire equation. If he was involved, this wasn't just about disproving suicide anymore. It opened up a third possibility, homicide. And here is one of the most misunderstood and most critical distinctions in the entire insurance world. How do these policies treat murder? For the life insurance policy, it's straightforward. If someone is murdered, the policy pays out, assuming you're past the contestability period and there was no fraud on the application. The only major exception is if the beneficiary, the person receiving the money, is the one who committed the murder. They call this the Slayer rule. And for obvious reasons, it prevents a spouse from killing their partner to cash in on the policy. But since Sarah was hundreds of miles away when Mark died, that wasn't a factor. But what about AD&D? Is being murdered an accident? Your first instinct might be to say no. An accident is slipping on ice or a car crash. A murder is an intentional act. But you have to look at it from the victim's point of view. From Mark's perspective, was his death accidental? Yes. It was an unforeseen, unexpected, violent, external event. He didn't plan it. He didn't consent to it. Therefore, in the cold, contractual language of insurance, being the victim of a homicide is generally considered an accident. This was the key, the tiny sliver of hope. I was now fighting a war on two fronts against two different insurance giants. For the $1 million life insurance policy, I had to prove a negative. I had to prove Mark's death was not a suicide to get around that 2-year clause. For the $500,000 AD&D policy, I had to prove a positive. I had to prove his death was an accident. And the strangest part? The darkest path was actually the most promising. Proving Mark was murdered could potentially unlock both policies. It would nullify the suicide ruling for the life insurance, and it would trigger the accidental death benefit for the AD&D. The man in the baseball cap wasn't just a ghost from Mark's past. He was the key to Sarah's future. I had to find him. I walked back toward the motel office. The clerk was wiping down the counter, his back still to the door. He told me everything he was going to. Talking to him again was pointless. But he wasn't the only one who saw what happened last week. My eyes scanned the grimy exterior of the building, tracing the wires snaking along the walls. And then I saw it, tucked under the eaves, covered in cobwebs but pointing directly at the parking lot. A small dome-shaped security camera. My heart started to pound again, this time with a surge of adrenaline, not fear. The clerk wouldn't give me a name. He wouldn't give me a description. But that camera might have a face. It might have a license plate. I pushed the door open, a new plan forming in my mind. The little bell chimed again. The clerk didn't even turn around. He just sighed a long, tired sound. I told you I don't know anything else. You're right, I said, my voice steady. You don't, but your camera system might. The clerk's shoulders slumped, a puppet with its strings cut. He turned, his face a mask of weary disbelief. You're kidding me. Those things haven't worked in years. They're just dummies. For show. I pointed to the small domed camera tucked into the corner of the ceiling, right above the door. A tiny red light blinked with metronomic certainty. Once. Twice. That one doesn't look like a dummy to me. Blinking red lights usually mean it's recording. Or at least it thinks it is. He followed my finger, and for the first time, a flicker of something other than boredom crossed his face. It might have been fear. The owner. He said they were just for show. Maybe he lied. I said, keeping my tone even. People do that, especially when it comes to liability. Now, think about this from my perspective. I represent a family whose primary breadwinner is gone. They had a life insurance policy which is straightforward. He died, so it pays. But they also had this accidental death and dismemberment policy. A big one. The kind that's supposed to be a safety net for a tragedy just like this. I took a step closer to the counter, lowering my voice. But AD&D, you see, it isn't like life insurance. Life insurance asks one question. Are you dead? Yes or no. It's binary. AD&D, on the other hand, is a detective. It asks 1,000 questions. How did you die? Was it truly an accident? Was there any contributing factor that would let us off the hook? Were you sick? Were you intoxicated? Were you breaking the law? Did you jump? Or were you pushed? The clerk swallowed, his eyes darting back to the camera. The burden of proof, I continued, falls on the family. They have to prove, beyond a reasonable doubt, that his death fits the policy's narrow, surgically precise definition of accidental. The insurance company, meanwhile, has a team of investigators, a legion of lawyers, all looking for one thing. An exclusion. An escape hatch. A single sentence in the 40 pages of fine print that allows them to stamp denied on the file and close the case. My job is to find the proof before they find the exclusion. I let that hang in the air. The little bell on the door remained silent. The only sound was the hum of the ancient soda fridge. That camera, I said, pointing again. That footage is proof. It's either proof for the family, or it's the exclusion the insurance company is praying for. Either way, it's going to be seen. The only question is whether you show it to me now voluntarily, or if you show it to a couple of uniformed officers with a subpoena in about an hour. Your choice. But I can tell you, the second option involves a lot more paperwork and a much longer conversation with your boss. He stared at me, his jaw working silently. The fight had gone out of him. He wasn't a bad guy, just a man paid too little to care. But now he was being forced to. He let out a final, defeated sigh, then lifted a hinged section of the countertop. Back here. I followed him into a cramped, windowless room that smelled of stale coffee and dust. A small desk was buried under stacks of old invoices and parts catalogs. In the corner sat a tower computer that looked like it had survived the dot-com bust, connected to a bulky CRT monitor. The screen glowed with a four-way split of grainy black and white images. The camera feed. Told you it was old, he mumbled, pulling up a rickety chair. System crashes all the time. Deletes footage at random. Probably nothing on it. Let's just see, I said, pulling another chair over. What's the date of the incident? He typed, his fingers clicking loudly on the yellowed keyboard. He navigated through a clunky, outdated interface. Here. This is the day. It stores about a week's worth of footage before it overwrites. We're lucky. Luck has nothing to do with it, I murmured, my eyes glued to the screen. We watched the day unfold and fast forward. Ghostly figures of guests checking in and out. The sun arcing across the parking lot, casting long shadows that quickly retreated. It was hypnotic and agonizingly slow. This is what families go through. They're not just grieving. They're forced to become forensic accountants, piecing together a life and a death from receipts and phone records. They're trying to build a case while the insurance company is trying to dismantle one. An AD&D claim isn't a process of compassion. It's an adversarial undertaking. You are, in effect, suing a multi-billion-dollar corporation for money you believe you are owed, and you have to prove it. Stop. Right there, I said. He paused the playback. The timestamp read 9:47 p.m. On the screen in the top left quadrant showing the walkway outside room 12, stood my client's husband, Mark. He wasn't alone. He was in a heated conversation with another man, a taller figure who stayed mostly in the shadows. We couldn't hear anything, but the body language was all venom, pointed fingers, aggressive stances. Who's that? I asked. Never seen him, the clerk said, leaning in. Not a guest. Must have just walked up. We watched frame by frame as the argument escalated. Mark took a step back. The other man pushed him. It wasn't a violent shove, more of a get-out-of-my-face gesture. But Mark was off balance. He stumbled backward, off the curb of the walkway, and into the parking lot. His arms flailed, and then he vanished from the frame. Seconds later, the screen flared white as headlights washed over the camera lens. The truck. The clerk let out a low whistle. So he was pushed. That's an accident, right? It's not that simple, I said, my mind racing. This is exactly the kind of ambiguity an insurance company loves. Was he pushed? Or did he stumble during a mutual physical altercation? Because most AD&D policies have a very clear exclusion for any death that occurs during the commission of an assault or a felony. If the company can argue that Mark was a willing participant in a fight, they'll say his death wasn't an accident. It was a foreseeable consequence of his own violent actions. That's crazy, the clerk whispered. The other guy pushed him. But who started it? Who threw the first punch? This video doesn't show that. It just shows the final fatal second. It's a lawyer's playground. My eyes were still scanning the screen, replaying the moment in my mind. Then I saw it. Wait. Go back. 10 seconds before the push. He rewound the footage. There. Just before the argument got physical, Mark reached into his jacket pocket. He pulled out a small dark bottle. Flask. He took a quick sharp swig then put it away. A cold dread washed over me. It was the kill shot. The ultimate exclusion. Intoxication. If the toxicology report came back and showed his blood alcohol was over the legal limit, it was game over. The company wouldn't even have to argue about the fight. They would just point to the intoxication clause, which states that no benefit will be paid if the loss is caused or contributed to by the deceased being under the influence of alcohol or narcotics. It's one of the most powerful weapons in their arsenal. They wouldn't have to prove it caused the accident, just that it was a contributing factor. And a jury would see a man drinking from a flask moments before his death and nod their heads. It's an easy narrative. The clerk saw it too. Oh man, is that what I think it is? He slumped back in his chair. So that's it then. He was drunk, he got in a fight, and he fell into traffic. Case closed. I didn't answer. I leaned closer to the monitor, my nose almost touching the glass. The image was grainy, distorted by the low light and the cheap camera. But I wasn't looking at Mark anymore. I was looking at the other man. The shadow. As he turned to walk away after Mark fell, his face was momentarily illuminated by the truck's headlights. It was a flicker less than half a second. But it was enough. My blood ran cold. No, I said, my voice barely a whisper. This case isn't closed. It was just blown wide open. The clerk looked at me confused. Because I know that man. I know who he is. And the last place on earth he should be is in a motel parking lot arguing with my client's husband. The man in the photograph, the one arguing with Sarah's husband in that grainy motel security footage, was named Marcus Thorne. But nobody called him that. In the circles I used to run in the darker, grittier corners of insurance law, he was known by a different name. They called him the Carpenter. Not because he worked with wood, but because he built things. He built stories. He constructed scenarios. He was a specialist in manufactured misfortune. If you wanted to lose a finger in a workshop accident for a $50,000 payout, you called the carpenter. If you needed your car to conveniently get totaled in a way that pointed to a faulty manufacturer part, you called the carpenter. He was a ghost, a phantom in the legal system, a man who could orchestrate an accident with the precision of a Swiss watch, leaving insurance companies holding the bag. And he was standing in a parking lot with Sarah's husband, Mark, just 2 days before Mark fell off that ladder. My blood ran cold. This wasn't just a simple claims denial anymore. This was something else entirely. The insurance company was denying the claim because they couldn't prove it was an accident. I was about to prove them right, but for all the wrong reasons. The case wasn't about a fall. It was about a conspiracy. My mind raced, connecting dots that I hadn't even known existed a few hours ago. The unusual credit card debt Mark had racked up. The secretive phone calls Sarah mentioned. The sudden purchase of that high-limit AD&D policy, separate from his main life insurance. It wasn't foresight. It was a business plan. I excused myself from the clerk's office, my heart pounding a frantic rhythm against my ribs. I had his name, Marcus Thorne. It was time to see what kind of structures the carpenter had built in the past. Back in my office, I dove into old case files, legal databases, and forums where claims adjusters traded whispers and warnings. For hours, I saw nothing. The man was, as his reputation suggested, a ghost. But ghosts leave traces. Ectoplasm, a cold spot in the room, and in the digital world, they leave a data trail. I found it around 2 a.m., buried in the footnotes of a dismissed lawsuit from 7 years prior in Arizona. A man had sued his employer after a faulty piece of machinery crushed his hand. The case was thrown out, but one of the depositions mentioned a consultant the man had hired to help him document his claim. The consultant's name was Marcus Thorne. I cross-referenced the plaintiff's name. A year after the case was dismissed, he was convicted of insurance fraud. It was a small-time conviction, but it was a thread. I pulled on it. Another case, this time in Nevada. A woman claimed she slipped on a wet floor in a casino seeking millions. Her claim was supported by an independent safety inspector who'd written a scathing report on the casino's negligence. That inspector's name? Marcus Thorne. The casino's lawyers proved she had intentionally poured water on the floor herself. She did 6 months in a county jail. The pattern was undeniable. The carpenter didn't just help with the accident itself. He helped build the story around it. He was the architect of the entire fraud from conception to claim, and his blueprint was all over Mark's case. The latter placed just so. The lack of witnesses. The timing just after taking out the policy. It was his signature work. But this time something had gone horribly, catastrophically wrong. The plan wasn't for Mark to die. The payout for death was significant, yes, but the payout for, say, a paralyzing fall from the waist down? That was also life-changing money. Money you could live to spend. This is where the brutal, unforgiving nature of an AD&D policy comes into sharp focus. It's a distinction that can mean the difference between financial security and absolute ruin, and it's something most people never consider. A standard life insurance policy, the kind Mark also had, thankfully, is straightforward. With a few exceptions like suicide within the first 2 years, if you die, it pays. The reason for your death is largely irrelevant. Sickness, accident, even your own foolishness, it pays. But AD&D, accidental death and dismemberment, lives and dies by that first letter. Accidental. It's not life insurance light. It's a completely different animal, with a rulebook written in blood and fine print. And in that fine print is always an exclusion for intentionally self-inflicted injury. Here was the devastating legal paradox I was now facing. Mark didn't intend to die. From his perspective, his death was a genuine tragic accident, a terrible miscalculation. But the event that led to his death, the act of getting on that ladder as part of a fraudulent scheme, was an intentional act. He intentionally put himself in harm's way. He was a willing participant in a crime. The insurance company's lawyers would argue that the entire chain of events was poisoned from the start. They would say you cannot intentionally set a fire, and then claim it was an accidental blaze when the house burns down faster than you expected. The fraudulent act negates the accidental nature of the outcome, and legally they would be on solid ground. My case for Sarah, the one I had been so confident in, was evaporating before my eyes. I couldn't argue that Mark's death was an accident if I knew he was on that ladder trying to commit a felony. But what about Sarah? Was she a grieving widow, or was she a co-conspirator? The thought made me sick. I remembered the look in her eyes, The genuine pain and confusion felt real. But I'd been fooled before. People can be incredible actors when $1 million is on the line. I had to know. I printed out the grainy photo of Mark and the carpenter in the motel parking lot. I printed the court dockets from Arizona and Nevada. I gathered every piece of this new ugly puzzle and put it in a file. The drive to Sarah's house was the longest of my life. Every traffic light felt like a judgment. What was I about to do to this woman? If she was innocent, I was about to tell her that her husband's death wasn't just a tragedy, but a sordid crime. That he had died while trying to cheat and steal. That he had been lying to her for months, planning a deception that got him killed. I would be destroying the memory of the man she loved. And if she was guilty, then I was walking into the home of a woman who was complicit in a high-stakes fraud. A woman who was trying to use me as a pawn to finish the job her husband had started. I pulled into her driveway. The porch light was on, casting a warm, welcoming glow that felt like a lie. I took a deep breath, the cold night air stinging my lungs. I grabbed the file from the passenger seat. This was it. The moment of truth. I walked up the steps and knocked on the door. She opened it, a tired but hopeful smile on her face. "Any news?" she asked, her voice a fragile whisper. I couldn't meet her eyes. "Sarah," I said, my own voice low and heavy. "We need to talk. Can I come in?" I sat her down at the same kitchen table where we'd first met. The same table where she had cried, telling me about the man she had lost. I didn't waste time. I slid the file across the table. I watched her face as she opened it. I saw her eyes scan the first page, a summary I had written of my findings. I saw the confusion morph into disbelief, then into dawning, gut-wrenching horror. She looked at the photograph of her husband with a stranger. She looked at the court records with Marcus Thorne's name on them. A single tear traced a path down her cheek. I let the silence hang in the air for a long moment, heavy and suffocating. Then I leaned forward and I asked the question that would decide everything. "Sarah, did you know? Did you have any idea your husband was planning to fake an accident for the insurance money?" Her face, which had been a mask of practiced grief, just crumbled. It was like watching a dam break in slow motion. The composure she'd held onto for weeks dissolved into a tremor that started in her chin and spread through her entire body. The tears weren't loud or dramatic. They were silent, heavy things that rolled down her cheeks, leaving clean tracks through her makeup. She didn't wipe them away. She just sat there, shaking her head, not in denial, but in a kind of profound, exhausted defeat. "I didn't know he was going to do that," she whispered, her voice cracking. "I didn't know he was going to cut off his own hand." The words hung there, obscene and unbelievable now that they were spoken aloud. But I knew he was going to do something. He was so desperate. We were losing everything. The foreclosure notice came, the final one. He kept saying, "I have a plan, Sarah. I have a plan to fix this. To protect you." He'd be in the garage for hours late at night. I could hear the tools. I don't know what I thought. Maybe he was fixing something to sell it. I didn't want to know. I was too scared to ask, because I think a part of me knew the answer would be something I couldn't live with. She looked up at me, her eyes pleading. He kept talking about the insurance from his work. The accident insurance. He said it was our only way out. He said if something happened to him, if he had a bad accident, we'd get $500,000. He said it was worth it. For me. For the kids we wanted to have. And that was it. That was the confession. She wasn't a co-conspirator in the traditional sense. She was a bystander to a slow-motion catastrophe, paralyzed by fear and denial. She was guilty of not stopping it, of looking the other way while her husband planned his own mutilation. But in the cold, hard language of an insurance contract, her knowledge, her suspicion was enough. It confirmed that this was not an accident in any sense of the word. It was a premeditated act. The claim was denied. Officially, the reason given was intentionally self-inflicted injury, a standard exclusion in every AD&D policy on the planet. You cannot injure yourself on purpose and expect the insurance company to pay for it. That's not insurance. That's a bizarre and gruesome business transaction. Unofficially, it was denied for fraud. We turned over all of our findings, the financial records, the analysis of the saw, Mark's own conflicting statements, and Sarah's heartbreaking confession, to the authorities. Mark didn't just lose his hand in the insurance money. He was charged with multiple counts of insurance fraud. The medical bills, which were already in the hundreds of thousands of dollars, were now entirely his responsibility. The $500,000 payout he had banked on to solve his problems had vanished, replaced by a mountain of debt that was now impossibly, apocalyptically high. The house was lost, of course. Sarah left him. The weight of it all, the lie, the horror of what he had done to himself and to their future, was too much to bear. In one desperate, misguided act, driven by a fundamental misunderstanding of a piece of paper, Mark had lost his hand, his home, his wife, his freedom, and any hope of a normal life. His story is a tragedy, a gruesome cautionary tale. But it is also the single clearest lesson I can possibly give you on the difference between accidental death and dismemberment insurance and real-life insurance. Mark thought he had a safety net. What he actually had was a lottery ticket that only paid out if he was struck by lightning in a very specific way. He built his entire financial escape plan on the weakest, most restrictive, and most misunderstood type of coverage that exists. AD&D is the fine print. It's a list of exclusions and specific scenarios. It covers only accidents. And the definition of accident is incredibly narrow. It doesn't cover sickness. It doesn't cover disease. It doesn't cover natural causes. If Mark had had a sudden, fatal heart attack from the stress of his financial situation, his AD&D policy would have paid exactly zero. If he'd been diagnosed with a terminal illness, it would have paid zero. If he had died in his sleep, it would have paid zero. And even within the realm of accidents, it's a minefield. Many policies have exclusions for things like drunk driving, acts of war, or injuries sustained while committing a felony. And as Mark learned, they absolutely 100% of the time have an exclusion for intentionally self-inflicted harm. AD&D is a supplement. It's the little extra packet of coverage that your employer often throws in for free or for a few dollars a month. And for that price, it's fine. It's better than nothing. But it is not, and was never intended to be, a substitute for a real-life insurance policy. That is the bedrock. A proper term life or whole life insurance policy is the foundation of a financial plan. Why? Because it covers death. Period. With very few exceptions like fraud on the application or a suicide clause in the first 2 years, if you die while the policy is in force, it pays out. Heart attack, pays. Cancer, pays. Car accident, pays. A freak anvil falling from the sky accident, pays. The cause doesn't matter. The circumstances don't matter. It provides a broad, reliable, powerful promise to your family. If I am not here to provide for you, this money will be. Mark and Sarah's fatal mistake was confusing the supplement for the foundation. They mistook the lottery ticket for the savings account. He was paying a few dollars a month for his AD&D policy and thought he had $500,000 of real protection. In reality, he had almost nothing. For probably less than $50 a month, a healthy man his age could have purchased a proper term life insurance policy for that same $500,000 amount. A policy that would have given him peace of mind without him having to resort to a power saw in his garage. A policy that would have supported Sarah if the worst had truly happened. So now you know. You've sat through this story, you've seen the gory details and the heartbreaking fallout. You are now more informed about this critical distinction than the vast majority of people who are walking around right now, thinking the free policy from their job is enough. Do not let this knowledge go to waste. Do not be the next Mark. I want you to do 3 things right now, or as soon as this video ends. First, pull up your employee benefits package. Log into your work portal. Find out exactly what you have. Is it just AD&D? Is it a small group life insurance policy that's maybe 1 or 2 times your salary? Know what you're standing on. Second, do the real math. Don't guess. How much is your mortgage? How much do you have in car loans, student loans, or credit card debt? If you were gone tomorrow, how many years of your income would your family need to stay afloat, to pay for college, to live the life you want for them? That 1 times your salary policy from work probably doesn't even come close, does it? And third, take control. A life insurance policy that you buy yourself outside of work is called an individual policy. You own it. You control it. It doesn't disappear if you get laid off or change jobs. It is your personal safety net for your family. Look into a term life insurance policy. For most people, it is shockingly affordable, and it provides the exact broad protection that AD&D so famously lacks. The difference between life insurance and AD&D isn't just jargon on a form. It's not just a minor detail in your benefits package. It's the difference between a real plan and a desperate gamble. It's the difference between a fortress built on bedrock and a shack built on sand. Mark and Sarah learned that in the most brutal way imaginable. Their story is a testament to the devastating consequences of a small misunderstanding. Don't let their tragedy be in vain. Use it, learn from it, check your coverage, understand your needs, and build a real wall of protection around the people you love. Don't just hope for the best. Prepare for it.